Dustin, guess what?
What?
It's Rivian Autonomy Day tomorrow.
I could have guessed that. If
Yeah, I
I
figured you would guess it right away.
I thought you were gonna tell me a joke or something. Well, I guess it kind of was a joke in the sense that I knew what it was, but
It's
yes,
the big
very big
day.
day tomorrow.
Um, I see Rivian is down a little bit today, which instead of waiting until selling on the news, they sell before the news now. So like
It's
this
great,
is
get
a
it out of the
game
way.
of like I know that you know, Mr. Market, that I know that you know that I know. So everybody's trying to like predict what's going to happen, and there is some de-risking going on by selling before the news, just in case
Totally.
people sell on the news, so you can be out a little bit before. But
Or if the news is not as strong as we hope,
right, right.
that's always a
Which there will
possibility.
always be that angle from some people, and there
Sure.
will always be this. Oh, this was the greatest announcement since the invention of bread by other people. So you got to always tame it, and try to determine what's real, what's not.
Right. There's also the angle of the news is as great as we hoped, but the market is still hesitant until the technology is in the hands of consumers.
Yes, yeah, which will
So,
most likely be the case. Like, it'll be like, okay, what they announced is probably pretty good, impressive if they can actually deliver. And the if is what people will be quibbling about and trying to
right.
determine, like where things should land. Um,
Yeah, it's different than like an iPhone announcement where like you pretty much know what you're getting from the announcement, where
on day one.
like on day one, where the autonomy, like there's so many different use cases, like it's
Right,
hard to know if the claims are actually real because you need real world testing.
right, right. So I'm excited. I'm flying over there tonight. I'm gonna spend the night at a nearby hotel, like literally across the street from where the Rivian event is at, and then I'll be there tomorrow morning, and I'll report back.
Please do
Maybe we
tell
can
RJ
hop
I
on.
say hi.
Yeah, maybe we can hop on a quick episode tomorrow and talk about it. You're gonna be watching it, I assume, right?
Yeah. What time is it at? Do you know? Well, I guess you
So
do
I,
know.
I believe it starts at 9 a.m. Pacific. So what is that?
Perfect.
Noon your time?
Yeah, around noon, I think. Yeah.
Yeah.
So I'll watch
All
it
right.
and eat some lunch.
What? Yeah. There you go. What else do we have to talk about?
Uh, so I do want to talk more about Rivian because there were some uh,
Mm,
consumer reports that came out. We have to talk about Warner Brothers, Netflix, and Paramount. I have a lot to say about that. Meta is reportedly cutting 30% of its Metaverse team. We're going to talk a little bit about earnings, and then we will get to listener questions as always, or as most of the time.
okay.
So, uh, going back to Rivian, did you see the consumer reports that it ranked like absolute top for customer satisfaction, but then ranked the lowest for reliability?
Yeah, I did see that. I thought that was like I think there's more good news there than there is bad news. Like if you have like a relatively unreliable vehicle, yet you're like so enamored by how great it is that you'd still be willing to buy it again, and that's how satisfied you are. That says a lot because reliability can improve. Like customer sat, it's hard to get like the first impression reversed. So obviously, you never want to see negative customer sat scores, but the
Right.
fact that they still have, I'm sorry, reliability scores, but the fact that they still have really high customer sat scores despite low reliability or like low relative to the car industry, that's pretty interesting. But one of the things that I also wonder is if these scores are based off of things that maybe customers don't experience in a typical ownership scenario. So, for example, if uh, Rivian is a new manufacturing company. So, if, for example, some percentage of their cars tend to have like more issues up front, those customers are obviously having what they perceive to be serious reliability issues. But the overall EV customer of Rivian, for example, or Tesla. Like this was also a thing during, you know, the times for the past 10 years that I've owned a Tesla, where Tesla reliability scores haven't necessarily been the greatest, but customer sat have always been really, really high, at least up until recently. But um, the thing when you're an owner of an EV that you also experience is like all of this time that you don't spend replacing your brakes or taking your car in for an oil change or just a general maintenance that you do with an internal combustion engine vehicle. And therefore, you know, if you're taking your car to the shop 3 times a year, but it's regular maintenance and it's completely reliable, but it's still in the shop for 3 days a year. Well, you don't experience that with a Tesla or with a probably with a Rivian. I haven't owned a Rivian yet, so I can't say that for sure, but most likely. So if you take those, you know, 3 trips per year to the maintenance out of the picture, um, your customer satisfaction scores could easily be, you know, improved because of that reason. So over the course of like 3 years or 5 years that somebody owns a vehicle, that's like 15 trips that you've saved. Now, if you had to go in for 4 times because of some, you know, thing that broke down, your reliability score might be low, but still you saved 9 trips overall to the service center. So, um, you know, some of that might be playing a role to improve the customer satisfaction score. So if they improve the reliability, the combination of the two for EVs in general is like really good.
Right. Also, as a newer car company, I would expect reliability to be on the lower end, given that they're figuring everything out, and
Right.
that it's easier for a newer car company to figure out those issues as opposed to an older car company that's been around for a while and maybe continuously having the reliability issues.
Yeah, that's absolutely true. And just EVs have a huge advantage over internal combustion engine vehicles, just because you don't have the oils, you don't have like as many moving parts,
Right.
and you know, like you have motors that last hundreds of thousands of miles as opposed to, you know, maybe 100 or 200,000 miles if you're lucky.
And
So
I don't think you mentioned this, but with the R2, they're also dramatically reducing the number of parts in the car,
yes,
which
yeah,
should further increase reliability.
yeah, yeah. So um, yeah, that's going to be a big factor. And then, of course, they need more service centers with the volume of cars that they're going to be selling. So they're trying to add those as they go. Um, I think 2026 will be a both a challenging year and a pivotal year for them, just because, you know, like the as the scale grows, they're going to have growing pains. You know, like Tesla went through this between 2017, 2018, 2019, where, you know, they were selling so many vehicles, but like the service centers were just coming online because you can't build them ahead of time, otherwise it's like way too much overhead. And you know, as you're selling more vehicles, you're building service centers, so you know, like some of that growing pains is going to be coming Rivian's way as well. So we'll see
Right.
how that unfolds.
Yeah. Okay. Want to talk about Warner Brothers,
Let's do
Netflix?
it, Ned. We talked about it a little bit a
We
few
did.
weeks
We talked
ago.
about it a few weeks ago before I think before Warner Brothers finalized that they were going to move forward with Netflix's bid,
Yeah,
which was $27.75 a share. But
a
before
lot
we
higher than I was
a lot
expecting, to be honest.
Yeah, I didn't really know what to expect. The initial offer from Paramount, because they started this whole thing, was around $21, I believe. So I guess, like, maybe if I was guesstimating, I would have said, it could go up to 25 or something. But, like, it is
Mhm.
crazy because the stock was trading at around $10 at the beginning of the year.
Yeah.
So, and it's only gone up because of this bidding war. It hasn't gone up it's been stagnant otherwise.
Right. Revenues are
So,
down, profits are down. Like it's never been profitable company. So stock price has quadrupled because of this bidding war. So yeah, it's kind of crazy. They were not in a good position. I mean, basically by all measures, they were in a similar to Bumble position where you
yes.
know,
And
revenues are
similar
down, like profits are down. But
similar to Bumble in the sense that I am a big fan of the CEO, Dave Zaslav. I think he's cleaned up the company a lot, and pretty much since he's joined or since, technically he was the CEO of Discovery and then Discovery acquired Warner Brothers, but since that has happened, his goal has been to have someone else acquire Warner Brothers and to clean it up for someone
yeah,
else. At least is
are
my
you?
take. I don't think he said that out loud.
Yeah. So, are you? What do you think of Netflix trying to buy them? Like, do you think that's a good thing for Netflix, or do you think that's too much of a distraction? Or
So
what are your
I
thoughts?
I think it's a win for Netflix. I think it's a win for shareholders. I think it's a win for David Zaslav. I think it is a potential big loss for the consumer. Um,
Okay.
so there's
Why do you
2
think that?
angles. Yeah, there's 2 angles to this. The first is there are fewer and fewer large movie, companies. So, like, Disney acquired Fox a couple years ago. Now we have potentially Netflix acquiring Warner Brothers. Especially with Warner Brother or with Netflix acquiring Warner Brothers, like, Netflix does not believe in releasing movies into theaters. Now,
Yeah.
uh, I know since this has all happened, they've changed their tune on that, and
Yep.
they have said, "No, no, no, Warner Brothers movies will still release in theaters." I mean, I'm sure that'll be true for the near future. I just am hesitant to believe them because they've had plenty of movies in the past that they could have released in theaters. Like, they bought, the Knives Out franchise,
Right.
and the first one did really well in theaters. The second one they released in theaters for, like, a week or 2, and then they pulled it and,
Yeah.
uh, put it on
But it
Netflix.
might be that the theater business is just dead to begin with, right? Like,
So,
and it could die even on its own, even if like you keep Warner
I think
Brothers
that's
as a
very
separate
likely.
entity.
Yes, so that is point number 1 of, like, the consumer that enjoys the movie experience, this is just, accelerating the death, which is probably inevitable. So my
Okay.
bigger issue is quality of content. So Netflix's quality of content is not great. I'm not saying that all their shows are bad, but they release a ton of stuff because they have a
Yeah.
different, like, green light philosophy where they think more is more, quantity over quality, and that has benefited them in certain ways. So, like, there was no telling that, Tiger King was going to be a viral hit, and
Right.
most places maybe would have not green light that or greenlit that. But, that has, been a big success for them. But the quality takes a hit because there's only so many dollars that can go around, and they can't afford to, like, go all in on individual properties outside of a few. So, like, Stranger Things, for example, right? Like, where they
Right.
know that has a track record. Where Warner Brothers has very strong quality, specifically,
HBO.
on the HBO, Max side. Arguably, they have the best quality content. The only other, streamer that I think is at the same level is Apple.
Yeah.
Um, so it's a
Apple
little
might even be slightly better.
could be, yeah.
They're
So it's a
newer, but
little yeah, it's a little worrisome to me, uh, having Netflix acquire Warner Brothers because of this quality issue. Now, it's the question is who's gonna rub off on who, right? Like, is
right.
Netflix gonna rub off on Warner Brothers, or is Warner Brothers gonna rub off on Netflix? Because if it's the other way around, then this could be a huge win. Because I think Netflix is burning a lot of money making shows that, like, either no one's watching or just aren't that good.
Right.
Because you don't need to make that you need to make content, but you don't need to make that much content. Like, no one makes as much content as Netflix right now.
Yeah. Yeah. Yeah, those are some great points, and I think I'm in full agreement. So let's talk about the deal terms. Like, what was
Yeah.
Netflix's offer? And I know that Warner
So,
or not Warner Brothers, who's it, Paramount, who
Paramount.
is doing a hostile bid. So, like,
Yeah, so
break it down for us.
before we even talk about the deal terms, a little history lesson here is before Paramount reached out to, Warner Brothers to offer the initial bid, Warner Brothers was planning on splitting into 2 companies. Uh, their film and HBO division, and then their linear television division. So it's going to be
Okay.
two companies, and that split was going to happen next year. And if Netflix does acquire them, that split will happen next year because Netflix is only interested in the film side for $27.75 a share. $23.25 is cash, and then $4.50 is Netflix stock.
Okay.
Paramount, since the beginning, has wanted the entire company. And I think the fact that they were going to split caused Paramount to put in a bid now before the split happened. If Warner Brothers wasn't planning on splitting, I think Paramount would have kicked the can down the road. There was no pressure to acquire them.
Gotcha.
And the reason why Warner Brothers wanted to split, going back to David Zaslav's goal, is they wanted to get acquired and they were basically splitting the company into their stronger assets and their weaker assets. So
Okay.
then the question is, well, why does Paramount want to own everything?
Both.
Well, the linear TV side, they own a little news network called CNN. And Paramount CEO is David Ellison, who is the son of Larry Ellison, the
Mm,
co-founder of Oracle, and they have very strong ties to, the Trump administration. I think there's an argument to be made that CNN is of high interest to them, in addition to
okay.
all the movie stuff. Plus, as a part of the, hostile takeover, so think I skipped over that, but you mentioned it. Paramount is trying to do a hostile takeover now that they lost the bidding war to Netflix, where it's $30 a share, all cash. Where are they getting all that cash from? Uh, they have
Larry Ellison's couch change, right?
that's majority of it, but then there's also Jared Kushner's private equity firm is
Okay.
backing it. So another tie to the Trump administration.
Ah, that's interesting.
Yeah.
So there's a good chance that the Netflix deal is gonna get killed, is what you're saying?
I think there's a good chance it gets killed. Plus, ignoring all the political stuff, Netflix is a much larger company than Paramount, right? So, like,
Right.
a smaller company acquiring another smaller company, I think it's just easier. Plus, they don't have to do the split, so it's also a quicker process. Where the Netflix deal wouldn't actually go into effect until at least a year from now.
Plus, it's a higher price for shareholders, right? Like, it's $30 as opposed
Well,
to
so it depends on how you look at it because they're buying both items, right? So, like, it's like Netflix only wants to buy the pen, and,
right.
Paramount wants to buy the pen and the ruler. So the question is, how much
How
is the
much is the
ruler if we know that this is worth $27.75? Now, David Ellison has said, the ruler or the linear television is only worth $1 a share.
yeah,
So
I
then
heard
they're
that.
offering way more, but, we don't know. Now, as a shareholder, or if I was a shareholder, which I'm not, I would be okay with "Oh, they're just kind of bundling these 2 together." Even if there was some sort of discount, like, I'd be okay with that. I think $30 a share is totally fair, especially given that they were only trading at $10 a share earlier this year, and I don't think their linear television business is strong. Um, but yes, they are offering more, but it's hard to know if it's truly the better deal because it's a question of, well, what would that other company trade for after Netflix acquires just the film side?
And if we look at the stock price right now, this is what's fascinating to me. Like the stock price for Warner Brothers Discovery is already right now trading at almost $30 a share. It's up like 4.5% today too. So like people, I think, are expecting the hostile $30 bid to go through as opposed to the other. And they're already pricing that in. Like, what's the upside from here? If you were a Warner Brothers Discovery shareholder, like, there's no reason to hold your stock anymore, right? Like, what are your thoughts
No,
about that?
I totally agree. If I was a Warner Brothers shareholder at this point, I would be selling. I
Out.
mean, the only chance of the price going higher would be if Netflix increased their offer or like something crazy happened. But I think the probability of all that is low. And even if they did, I don't think they're going to increase it by that much more.
Right, right.
Um,
Plus, Netflix's
and
stock has gotten hit since the offer. So, like, the market is viewing it as a very negative deal for Netflix in particular. Like,
yes,
they're overpaying.
yes, that is true. Um,
What were you gonna
the
say,
other
and what?
the other angle I want to take on this in terms of like the positive side of Netflix potentially buying Warner Brothers is I was thinking about when has a disruptor purchased the disrupted? And I don't think it's really happened that often, specifically in tech. Like we've had examples of dis the disruptor being bought by the disrupted, a la Facebook and Instagram,
Right.
but uh, we really don't get much of this. The only example I could think of was, and this is a bit of a stretch, Amazon buying Whole Foods,
Hmm.
where you have online shopping buying, physical shopping. And
But technically speaking, Amazon never, like, penetrated the grocery market in particular.
I don't they have Amazon groceries, but that might have been because of the Warner Bros, the Whole Foods deal, but
Yeah,
I
that
don't
I mean, that
remember
happened
what the
after.
timeline was.
Yeah. I think they
But
tried several times, and several people had tried doing grocery business, but they could never like, online grocery delivery, but nobody succeeded at it.
right. But I do think that was, and this is just my take, I'm sure other people will disagree. I think that was a win as an Amazon customer. Like, you
Yeah,
get better integration of Amazon groceries, of groceries being delivered to your home, which I used to use when I lived in the city. You get when you go to Whole Foods, it's much easier to return your Amazon products. You can return your Amazon products anywhere. And
right.
then if you're an Amazon credit card holder, you get all the Amazon rewards at Whole Foods. So like there are definitely elements of this deal that like maybe it's not as bad as I'm thinking. Maybe they're going to do some great integrations that, you know,
Yeah.
time will tell, but
One of the ways that I look at it is that because the whole industry is struggling, like meaning not many people are making money off of creating content like HBO, for example, or HBO Max. Even I think Apple TV business, the content business is like more cash consuming than cash generating. I think that's true also for Amazon Prime. All of these companies have been like investing in this sector of their business uh, for a long time now, and like they borrow heavily to make this content because like
yes,
these shows cost hundreds of millions of dollars to produce. Um, and at some point, the money is going to run out, and I think post COVID, that has already begun. Meaning, like AT&T was who owned HBO Max was like, wait a second, this is like too much for us. Like they spun it off, and they're like, now it's your problem. Like go figure it out. And of course, Warner Brothers Discovery, since it's been a publicly traded company, its stock price has less than halved in the past 4 years, and it's only up because of this deal. So Netflix is the only company that is making money producing content and doing all of this stuff. And in a way, it's a lifeline to the content industry. So I think like it might be a win for the consumers. I'm not sure it's a win for Netflix. They take out a competitor, but that competitor was like on a downward
they're going
spiral
to own
anyway.
they're going to own so much IP that I think it's going to be a win. Like Harry Potter, Scooby
Yeah.
Doo, DC, like
Yes.
Game of Thrones. I think that's a very big win. I mean,
That
it's
is a
hard to know
big
what
win,
the
but is it
monetary value is.
$80 billion worth
Right.
of
Exactly. Yeah.
like that's the big question. And that most of that content is historical, meaning it doesn't have the same viewership today that it did. Like, nobody's watching Game of Thrones today. They're watching the sequel to it or whatever. Maybe a fraction of people maybe are watching the sequel to it. But HBO has been like pretty good. It has a great reputation of creating great content. So, you know, maybe they're acquiring some of that for the talent. But fundamentally, it was sort of like on its way down. It'll be interesting to see how this plays out. One of the other things that Netflix may have been doing is just trying to keep it out of the hands of its competitors to not allow them to get stronger, knowing that the DOJ is not going to approve this deal, right? Because they're the 800-pound gorilla. They're the only ones making money, and they're like now acquiring the second. Depending on how you look at the sort of market, they're essentially acquiring the closest competitor to them, HBO Max. And that's probably not going to be looked upon favorably in any kind of administration, Department of Justice, not just the Trump administration, who might have closer ties to the other side.
So
So
my
yeah,
my pushback on it being a defensive move is, one, I think Paramount has one of the weakest streaming platforms in Paramount Plus. So it's
yeah,
not like it's, I don't know, Disney Plus, which already has Hulu. Like it's not, they're not creating a monster. I don't think Paramount Plus HBO Max, like most people are only subscribing for HBO Max in that case anyway. And
right,
then,
right.
the other piece is there is a breakup, fee. So if this deal does not go
Mm.
through, regardless if Netflix pulls out or if it doesn't get approved, by the government, Netflix has to pay $5.8 billion to
Oh
Warner
wow.
Brothers.
Oh really? I did
So
not know about that. That's a huge deal.
yes. So if
That's
anything, I think
interesting.
there's a world where David Zaslav at Warner Brothers is like, you know what? Let's try to do this Netflix deal. Worst case, it doesn't work out. We get $5.8 billion and then we go to Paramount.
Huh. But if I was
I'm not
Paramount, like
saying
that,
that's gonna
like
happen, but
if the deal gets killed, I think the value of Warner Brothers goes down significantly because
oh yeah.
the only
It goes
reason it's
it goes
getting
right
this,
back down to $10 or less.
yeah, like maybe like Paramount comes back in with like a $15-20 bid and still wins it because there's nobody else who's going to be around to buy it, right? Like, maybe Apple or Amazon, I don't know.
See, like, I
Um,
would have loved if anyone if any new player had to buy it, I would have loved to see Apple buy it because I think they're on the same wavelength in regards to thinking about, high quality content.
yeah, yeah.
And Warner
Apple's
Brothers
content
produces
is
some of their
good.
shows already, like, Warner Brothers produces, Ted Lasso.
Oh, really? I did not
Yeah,
know
and
that.
that's another weird dynamic. So, like, is Netflix gonna produce content for other people now? Like, it's
Yeah. Ted Lasso
yeah,
is like one of my favorite shows. Anyway,
yeah, it's
all right.
awesome.
I think we probably talked about that one
Yes, we
enough
ranted
for
enough. I'm done.
the and
Okay.
neither one of us has stock in either company anymore. I sold all of
No.
my Netflix shares. I think my last sale was around 800 or 900 bucks. I don't remember, but
Yeah,
like,
I used to own Netflix, I used to own Warner Brothers. I knew Warner Brothers was gonna get acquired, I just didn't think it was gonna happen this quickly, so,
yeah,
okay,
my sale 800 or 900 bucks was pre 10-for-1 split, so 80 90
right,
dollars somewhere in that neighborhood. And what's funny about Netflix is that it oftentimes comes back around and like dips down below what I've sold it for years later. Like
yeah,
I sold it in 2018, and then in 2023 I bought it for less than I sold it for in 2018, and the company was like double the revenue, way more profitable, all that stuff. So uh, that cycle has been very fruitful for me, the Netflix
totally.
cycle.
Yeah, if you could ride the waves.
Yeah. All right.
Um,
Meta, is that what you said?
Meta. Yes, so Meta reportedly is planning on slashing 30% of its, Metaverse, team. What are your thoughts on that? Because I know you were very bullish on the Metaverse.
Well, I'm bullish on the way in which Mark Zuckerberg is building out their teams and focused on various different areas. And I'm so curious because they haven't, like Mark and Meta haven't commented on this 30% report, right?
I haven't seen anything. I think it was just, like, rumors so far.
Yeah. So, I mean, I could see them, for example, repositioning talented people from like focusing on the metaverse to focusing on AI and other areas. And like maybe 30% of the teams are getting moved around, or 30% of the members that used to be focused on metaverse are being focused on AI. The external report would come out this way, but like internally, there might be like literally zero cost savings from the standpoint of like why some investors might be excited. I think their stock went up like 4% that day that that rumor came out.
Yeah.
Um, maybe expecting that they're going to save a ton of money all of a sudden, and that's all going to go to their bottom line, because they've been spending upwards of like what, $20 billion a year on the metaverse, maybe more. But like, I suspect this is not a, $5 or $10 billion annual savings that's going to flow to the bottom line. Instead, I think it's going to be just moved around and shifted focus, which I think
Yeah.
is probably the right call, right? Like I feel like I trust Mark's judgment in that sense, that like, let's focus it on more on AI. Let's improve. Like, he's also like more recently focused on acquiring like design talents and trying to like improve user experience, and some of these other aspects of it that I think are missing for, if you want to sell like 100 million glasses, you better get the experience right. And so far, I think they have failed in that department.
What gives me pause, and I trust Mark as well, but what gives me pause is one of the core reasons why I invested in Meta. It was before all this AI stuff was even happening. It was that whether they said it or not, they knew that social media was dying, it's becoming less relevant than it was a decade ago. And they knew they needed to pivot. So it was pivoting into the metaverse, pivoting into AI. So I don't want them to take their foot off the gas for either of these industries, because while the metaverse hasn't necessarily taken off, I do think the products are great. Like, I have a Quest Pro,
Right,
uh,
right.
and
The
I
Quest
use it
Pro in
all the
particular is not that great.
I see. I actually, well,
You
it's all
use
I
it?
know, so I love it.
Okay.
Um, but
You should you
like
should get get a Quest 3, or
3, maybe
3S,
I'll
or
wait for the
whatever it is now.
4. Yeah.
Yeah. That
But yeah,
it,
like I there's something there. They're currently, in my opinion, the market leader in this space.
yeah.
So I don't know. I it gives me a bit of pause. But to your point, I agree. I do trust Mark in what he's doing.
Yeah, I think there's like a really good opportunity for like an incredible AI augmented reality experience with, especially their new glasses that they have come out with that have the displays, but also with the VR version, where you could have like a character, like as soon as you put on the VR, like a character could, like be displayed in front of you, that is basically your AI Oracle, and
Yes.
it's like, what would you like to do? Like, and you're having a conversation with it, and it can actually do all kinds of stuff. And if they put together an interface like that, I think this they could have a killer product on their hands, with
Do,
both a VR version of that, where it's like completely immersive, and you can start working on documents with the help of this character that's like, Jarvis, essentially, that is with you all the time. And yeah.
do you
what,
know
what would
the video game Mega Man?
uh-uh what is that?
So it was like a very popular game. They kind of they I want it's not rebranded, but they came up with a totally new concept for the game for the Game Boy Advance, where it was Mega Man EXE.
Okay.
And Mega Man was this like living AI assistant that you would like have on your, phone, and you talk to it, and then like it would literally interact with the internet for you. But that's what I've always wanted from AI is I want like
Right.
a digital human that's like my little buddy
Yeah.
that just helps
You
me out
want
with
Jarvis,
everything.
basically, like, and
Yes, from
there's
Tony
an
Stark, yeah.
opportunity. Yeah. From yeah, Iron Man. Um, yeah. So I forgot what like I was gonna say about that, but I think that they have like great opportunity in AI combined with AR, VR hardware, that I think has close to zero revenue for them today, and it feels like something that could have incredible potential down the road. But their entire growth on revenue growth so far has been happening by utilizing AI to deliver better, more relevant ads. And
Yes.
ironically, they're like making more money off of AI without an AI product than anybody else, and their revenue is growing faster than anybody else of the big companies. Between Google, Apple, Microsoft, and Meta. Meta is like has the highest revenue growth rate, highest profit growth rate, and they're claiming that AI is the reason for both of that growth and profitability. Um, so when eventually they have products that utilize AI, that's going to be a whole new revenue stream for them, and I'm kind of excited to see what happens there. That's the reason why I'm excited about Meta in particular as one of
Right.
my investments.
I wonder, like, in regards to these ad optimizations, did they have to build the AI in-house to get the optimizations, or could they have used
Mm.
ChatGPT, Gemini, and saved all of that expense, you know?
It feels like that would be doubtful because I feel like the data that they would have to train the AI with is like very proprietary, and like how do they probably
Right.
wouldn't even want to like give that data to some third party. But
Yeah,
yeah, hard
that's
to
true.
know.
Okay, should we talk about earnings, and then we can go to listener questions?
Yeah, let's do it. You want to pull up the earnings or should I?
I could do it.
All right.
Okay, so this
Oracle.
afternoon, we had Oracle. Speaking of Larry Ellison,
Yeah.
let's okay, so we have it right here. Revenue, was a miss by 0.71%. Uh, they were expecting, 16.17 billion dollars, and they reported $16.06 billion. And then EPS was a big beat of, 50.67%. The expected EPS was $1.50, and it came in at $2.26.
That's a massive beat on EPS. That's so interesting. What's the stock? What did the stock do after hours?
I'm
Are we having a?
trying
You
to
might have to
get to it.
refresh. I wonder.
Oh, I need to go to 1 day, or
Okay, stock is down
yeah,
after hours.
down. Yeah, down to like 208 from
Okay,
223.
that's pretty decent decrease, like 5%, down 5% or so.
Yeah.
Um, I haven't been, or 6.5%. It looks like I haven't been a huge Oracle fan. It's one of those companies where especially being a software developer or coming from a software developer background in the 90s and 2000s and so on, Oracle was the company that everyone hated. you know
Yeah.
um, so I've never warmed up to Oracle, and it's still like one of those companies where I'm like, all right, interesting. I'm impressed that stayed relevant. And to Larry Ellison's credit, he has been like super relevant in helping shape the industry, not just like by shaping Oracle, but like he is the guy who was the best friend of Steve Jobs and talked Steve Jobs into going back into Apple, and like was trying to talk him into buying Apple when it was like only $4 billion company. Um, Back in 97, but ended up being like on Apple's board and being 100% supportive of Steve. And then again, like he's the guy who has been backing Elon Musk, and during the turmoil of Tesla in the like 2016, 17, 18 timeframe, he was like a huge supporter of Elon. And this guy's been relevant in all the right ways, and like
Yeah.
he's like what, an 80-year-old tech guy. Like it's super impressive how he's been so relevant this entire time. How old is he now? um Larry Ellison, 81 years old. Like that's pretty damn impressive. And like being and he's invested in X with when Elon tried to buy Twitter. He basically helped them by like being one of the funders of it, to the tune of at least $1 billion. I don't know the exact amount that he invested, but yeah, it's fascinating to see how he's like now like jumping on the OpenAI, maybe Sam Altman, like backing Sam Altman. It's
Yeah.
it's,
Yeah,
this
he's
guy is
extremely active.
yeah, and he's been like
And
right about so many things throughout the past few decades. But like Oracle as a company, I'm like, um,
yeah.
yeah.
Yeah, it's not a fun company, you
Yeah,
know?
it's a
Uh,
database company, but
yeah.
somehow like they have their hands into everything, and they're doing Oracle Cloud and providing data center services. All right, well, how did Adobe do? Did they already report as well?
Yes. So that was a beat for both revenue and EPS. A 1.4% beat for revenue. They were expecting $6.11 billion, and it came in at $6.19 billion. And EPS was a beat of 10.2%. They were expecting $4.99, and it came in at $5.50. And let's see, what is it doing? Market pretty much flat.
Yeah, after hours is flat.
Yeah,
All
that's
right.
Adobe. Adobe, I mean, I think we maybe talked about this a while ago, but Adobe is just such an interesting company in this AI age where everyone kind of thought they were going to be dead from because AI was going to replace them. And then they just integrated AI throughout all their products, and it just made their
Yeah.
products even better. Um, so it's an interesting time to be an Adobe investor because the story is very much not over.
Adobe was basically called a dead company that walking during the um, desktop application to SaaS transition as well. And Adobe made that transition by introducing their Creative Cloud subscription and moving everybody and pushing all of their customers to the Creative Cloud. And because they were selling a $600 or $1,000 product before, and then all of a sudden they were selling a $50 subscription, monthly subscription, their revenue actually dipped down at first before it started to go back up. And during that like dip down, this transition started like, I don't know, maybe 10-15 years ago. And uh, initially it looked really bad for Adobe, but then like they came out on the other side with like this subscription revenue that was just like destroying it and way more stable. And um, uh, so they've made this type of transition once before, uh, which will be interesting to see if they make it again with AI. Um, do you know who runs Adobe? Is it the founder,
I don't know.
CEO of Adobe? Let's see. Shantanu Narayan, who was the founder.
He's been the CEO since 2007.
Okay, the Adobe founders are not there, but he's been the CEO since 2007. So yeah, I mean, if long-term CEO, he's got the cloud. He'll probably be able to make that transition.
Yeah.
2007. That's 18 years. That's a pretty long tenure
Yeah.
in the tech industry. So he's like witnessed it all basically.
Do you want to talk about any other earnings, or should we jump to listener questions?
Let's do listener questions if we have any, and if not, I can go catch my flight.
We do have a few, so we'll kind of, I'll just bang them out if we can.
Yeah, let's do it.
Okay, so we have someone asking, and he's referencing the glasses from Meta, but I guess there was an announcement from Google to revamp their AI glasses. So we were wondering, there's a question about that.
Yeah, so I think that I actually happened to experience Google's glasses at the TED conference last year, or this earlier this year, I should say, in April. And they were basically on par with the Meta glasses. And I had a conversation with the guy behind the technology of Google's glasses, and I asked him like, "Where are you guys with respect to where Meta is on these things?" And he said we're probably about a year behind Meta. And that was like sort of his admission that uh, they're behind because Meta has been investing so heavily in these glasses and AR VR. So if Google comes out with glasses, this is a market that is not even remotely close to saturated. There's no leaders yet. Like even though like Meta is the leader, like we're talking hundreds of thousands of units, and the eventuality of this market is going to be in the at least tens of millions of units, possibly hundreds of millions if it's actually successful. So you could be a late entrant even when somebody else already is on pace to do 1 million units a year and still destroy it, because if your pace of growth is faster than them, you could do really well. So the market is by no means decided, and Google could be the entrant that does it. OpenAI could be the entrant that does it and like really succeeds in this space. So it's undetermined. From my perspective, it would be hard for a company like Google with a CEO like Sundar to get this right. My bet would be on Mark Zuckerberg over Sundar, but if Sam Altman were to actually come into this field, he might do better than even Mark Zuckerberg, because I feel like he has a better sense on user experience than even Mark does. So that would be sort of like my take on that.
See,
What do you think, Dustin?
my bet would be on Google if it's just Google versus Meta,
Meta?
because I think my gut reaction is Google's going to have the better software and the better AI, and Meta's going to have the better hardware. But the fact that Google thinks they're only a year away, and we've seen the demos, like Facebook had the demo really early on of their like prototype, and I thought they were years behind. And then Google started to show off their technology, and it was actually much closer than I thought. So I think the gap, if Google could just catch up to Meta on the hardware side, I think their software is going to beat them out, which goes back to my concern of Meta slowing down on Metaverse spending, because I think there's a lot of strong competitors, including OpenAI, in the space.
By the way, we shouldn't count Apple out either. Like if Apple
Yep.
actually comes out with something that's priced right, and like God help Tim Cook, he won't be able to get the pricing right. Like they come out with glasses, it's going to be like $2,500. It's going to be dead on arrival. But if they get a sub $1,000 pair of glasses that's priced right, they get the user experience right. Usually, they also could have a really good shot at it.
Well, keep in mind with an Apple glasses, it's the only ones that will work with an iPhone. So they have that advantage.
Well, technically, the Meta glasses work with your iPhone, but they're not as well integrated as Apple's
Right.
would
It's
be.
similar to smartwatches, right? So like the Apple Watch only works with iPhones, will not work with any other phone, and works best with
Right.
iPhones, where you can use a Fitbit with an iPhone and it's fine.
Yeah. Agreed. What else we have,
You ready to
Adrian?
move on?
Let's do it.
How might a future SpaceX IPO influence Rocket Lab's valuation, competitive positioning, and investor sentiment?
Yeah. So I think like what's nice about SpaceX not being public is that all the attention, if you want a space company, there's only one. Like Blue Origin is not public. SpaceX is not public. Blue Origin is Jeff Bezos' company that just put sent satellites to Mars, actually, using the New Glenn rocket, which super impressive, even bigger than the Falcon 9 rocket that SpaceX has been doing, and it landed back on their drone ship as well. So Blue Origin is basically just accomplished what SpaceX has been doing with Falcon 9, but with a much bigger rocket. So they just basically came on the map with their second launch, and like boom, like they're a serious player in this space all of a sudden. But they're not public. If they were public, they could easily be $100 billion company as well. And then SpaceX becoming public, though, I think would be goodness all around. Like, it would be good for the enthusiasts who want SpaceX shares because they love SpaceX as a company. The sooner, the better. But like, I feel like they're IPOing so late at such a high valuation that most of the upside will have already been baked into the $1.5 trillion market cap price that SpaceX is rumored to go public at. So, where's the upside for a $1.5 trillion company that this year's is estimated to have roughly $15-16 billion in revenue. So, if next year they even do, up 60-70% from that, they have 25 billion in revenue. $25 billion revenue company being worth 1.5 trillion. That's just like incredibly high multiples for a very high market cap company. So that would, but what that would mean is that some of the others might get higher valuations as a result. So it's probably a good thing for Rocket Lab. You can't say for sure, because if you apply the revenue multiples, Rocket Lab is already getting a really high revenue multiple, even at today's prices. So, but some of the enthusiasm around Rocket Lab right now might be because of SpaceX going public. So today, for example, it went up 7-8% based on no news for Rocket Lab itself. So it could be going up because of the SpaceX news, for example. So, I would say that a lot of it is probably already baked in to their prices. Now they kind of need to perform and actually increase revenues and profits in order to really go up further from here.
You want to move on?
Let's do it.
Hamid, are you considering any new positions for 2026 or evaluating fresh opportunities for entry as the new year approaches?
There's nothing on my immediate radar right now, but I had most recently added to my Meta position when Meta was down in the $600 price range. But I'm comfortable with that position right now. I'm comfortable with my other positions. Nothing in the immediate term, but things every now and then will cross my view, and I'll consider them then. Are you considering anything, Dustin?
No, the only thing I'm evaluating going into the new year is the distributions and allocations for my portfolio, because they've really just kind of evolved how they've grown, and I
Yeah.
never have really done a rebalance or thought too much about it. So I think just taking a step back and thinking about, how much of this company do I really want to own in my portfolio? Should it be more? Should it be less? So that'll probably happen sometime next year.
Gotcha.
Okay, let's talk about Rivian. How
good.
long are you planning to hold Rivian stock? For how many years?
I don't think of it like that. I mean, I do think of it from a long-term perspective. I expect to own Rivian long-term, but oftentimes it's because I expect the market to recognize what I'm seeing earlier than the market, perhaps over time, right? So if Rivian continues to grow as its revenues and profits grow, and the market adjusts its price, but I think of it as undervalued the entire time, I might not sell significant portions. I might sell some, but I might not sell significant portions. So I might have some of it for many, many years. On the other hand, if it 10x tomorrow for some reason, that might be a little too much, right? So I might sell a significant portion of my my position in a short period of time. So I think of it from the standpoint of, do I feel like it's now appropriately valued, undervalued, or overvalued? And if it's undervalued, I'm usually accumulating. If it's appropriately valued and I have accumulated too much, I might sell some just to de-risk, because then I might be thinking of it from a rebalancing my portfolio perspective. And if I think it's way overvalued, then I'm probably going to sell a lot, and I might hold on to some just because oftentimes the market swings in a pendulum style, going way too high or way too low in both directions. So that's the way I think about it. Hopefully that's helpful.
Staying with Rivian, kind of. Do you imagine Mind Robotics to build humanoid robots for Amazon?
I haven't looked much into Mind Robotics. This is the company that Rivian has spun off. My understanding, based on RJ's commentary, is that Mind Robotics is going to be looking at problems in the manufacturing sector, meaning companies like Rivian deploy thousands of robots to manufacture vehicles. and they want a company that is focused on solving their problems using robotics. Now, whether that's humanoid robots or specialized robots for a manufacturing type of environment, they don't really care. They just want to solve the problem for the least amount of cost, highest amount of efficiency, right? So there's no reason to box Mind Robotics down with like, you have to build humanoid robots. There's no need. But you can build ARM-based robots that are way smarter than the existing ARM-based robots that are like very dumb, meaning like they specifically pick up one thing from here, put it over here, and they can do this 1,000 times per day or whatever very efficiently, but they have no intelligence to be able to be like, wait a second, the shape of this thing changed that I'm picking up. I need to actually pick it up this way or some other way. And if you can apply intelligence to those robots, then they could potentially become way more productive. And my understanding is that that's what they're trying to do with Mind Robotics. They're not necessarily trying to create a specific type of robot, like a humanoid robot, which is what Optimus and Tesla are trying to do. So, and then whether or not they build and sell those robots to Amazon in particular seems like arbitrary, and I don't think that's like if maybe Amazon's going to buy some of their robots, who knows? But there might be other companies that buy their robots as well. But the opportunity is pretty enormous, and it's also too early for me to be able to assess any of it.
I don't know much about Mind Robotics, but assuming that they're using or are going to use these robots in Rivian factories, it's probably more likely that an initial client could be Volkswagen, which is another company Rivian has a strong
Right.
relationship with.
Or the automotive industry in general.
Right.
Yeah.
All right, let's do one last one. Very introspective for both of you. Hamid and Dustin, when you first started investing, did you have any guidance from family? Did you dive in on your own? Also, do you remember the first stock you bought?
Dustin, you want to answer that first?
As you know, my family does watch this. They taught me nothing. I learned it all on my own.
We forgot to give a shout out to your mom, by the way. Shout out to Melanie.
You have no idea what you're doing. I bought
Go ahead.
some stocks when I was like in high school. I think we talked about it, not on the podcast, but offline, about how I bought Solar City because Tesla was going to acquire them. But I didn't really like do much investing. What really brought me into investing was Bitcoin, where I started learning some more about the principles on the technical analysis side, right? Like it's not going to teach you what's a strong company, what's not a strong company. And then I guess during the COVID crash, I became more interested in stocks like everyone else did. And I work at, on Savvy Trader and Earnings Hub, which are two investing products. So that has helped me better understand, what makes a strong company. And obviously I work very closely with Hamid, and that has helped tremendously as well.
Very cool. So my interest in stocks came because like I always wanted to own my own company and I wanted to know how companies and stocks worked. And I remember having these conversations with anybody who knew anything about business. My brother-in-law was like probably one of the first people that I asked about this stuff because he was older than me. And I wanted to sort of like understand how stocks worked. I couldn't have been more than like 13, 14 at the time. And he sort of explained it. And then I started like back then, stock prices were listed in the newspaper. So I'd start like following random stocks based on the price of the stock. And then, later on, I think I was probably around 19, 20 when I first bought stock. And I can't remember what company I initially bought stock in. But yeah, I've been investing for a long time, more than 30 years now. And early on, I learned a lot of, I should say, like, I made a lot of mistakes because like I was buying based on all the wrong reasons. And sometimes I was buying based on hype. And during the dot-com era, it was like all hype everywhere. And like I rode that wave up and crashed pretty heavily as well. Um, I think I kind of remember rough numbers. Like I may have put in as much as $5,000-6,000 into the stock market, and at one point, it during the dot-com boom, it had like ballooned in a year or maybe less than a couple of years, um, to like I want to say over $90,000, and I was like, wow, this is incredible, right? Like, but then like literally within a year, it was back down to 5,000-6,000, and I had lost like 95%. And you get anchored to the highs, right? Like so when your portfolio goes to $90,000, and then next thing you know, within a year it's back down to 5, you're like, god damn it, this was terrible. But that taught me lessons that like lasted me to this day, to where like, no, don't buy based on hype, buy based on good valuations, right? Buy good companies or great companies, ideally for good prices. And that's what I learned from that book, One Up on Wall Street. And I think that book like really, really helped me shape my investment philosophy over time. Like the concepts from that book is what like stayed with me, and like I didn't apply all the concepts initially, but then like over time I like applied many of them, not even necessarily knowing it, but it was just in the back of my head. So yeah, that's been my investment journey.
One other piece I want to add is when I was starting to invest, I never invested more than I was willing to lose, knowing that I was actively in like learning mode. So like it was totally fine if the stocks went up, if they went down. Like I just wanted to understand or like better improve my own philosophy and way to go about investing. And I'd write everything down. I'd write down, why am I going into a stock? Why am I exiting a stock? And then figure out, is there a correlation of like, oh, every time I invest based on X, the stock doesn't necessarily perform well. Maybe that strategy is not working for me. So in some, I'd like to fail quickly when I was initially investing. Now I don't like to fail at all, but still seems to happen.
Uh,
I think that is it for this episode of Buy Hold Rant. Thank you all for listening. Thank you for liking, commenting, subscribing, rating us 5 stars wherever you listen to your podcasts. We appreciate it.
Awesome.
As always.